Alaikum. My name is Khalid Spet, and this is my analysis of the National Agricultural Development Company, or as it's known as NADEC. In this analysis, I'm going to go through the company's financial statements, specifically the balance sheet and the income statement, and we're going to analyze it using ratios and common size financial statements. So to start, let's go through the company's overview. The company is specialized in food and beverages sector. It was established in 1981 in Riyadh, and Riyadh is the headquarters. It's one of the biggest companies in that sector in the Middle East. It's worth now 2,380 million Saudi riyals in book value. Additional information: the government owns 20% of its shares, and the remaining 80% is trading in the Saudi stock market. So the analysis, as we said before, was going to contain common size statements, and as well as calculating ratios and two-point analysis. So let's go through the common size balance sheets. First of all, let's give a quick explanation of the balance sheet. The balance sheet shows the company's assets, liability, and owner's equity. It shows the company's financial position during a specific year. But what is the common size balance sheet? It shows every item in the balance sheet as a percentage of total assets. It is easier to read for the analyst. How is it easier to read? Well, when you see a percentage, let's see, total shareholders percentage is above 50%. That means that assets are mostly financed by owner's equity, which is, as the next point said, interpretation can be more clearer. When you see the owner's equity has more percentage than liabilities, that means that it's less risky. You can safely say that because the more obligations the company has, that means it's more risky to invest in. So this is the common size balance sheet, as we can see here. This is total assets represent 100% because every item is represented as a percentage of total assets. Let's go through the most important things here. We can see that non-current assets represent 72% of the total assets. And the most important two things here, we can say the total shareholders' equity and total liabilities. Shareholders' equity in 2019 represents 37% of total assets, while the remaining 63% are liabilities. Now that could indicate some risk for investors because the company is mostly financed by debt and has a lot of obligations. If we compare it to the previous years, we can say it's mostly similar. The percentages are closer to each other. 2016 has we can see that 2016 shareholders' equity was actually less. So in the 2017 was the same until we got to 2019. It is the higher here, which means that they paid some of their liabilities. Here, liabilities was 65%. In 2019, it was 63%. So liabilities are less through the years, but it's still higher, and assets are mostly still financed by debt. Let's go through the common size income statement. So income statement actually shows the company's profit and loss. by deducting expenses and interests and tax from revenue until we get to net profit. So the common size income statement is not different than the common size balance sheet. It shows every item in the income statement as a percentage of total sales. If we go through here, we can see this is the common size income statement. So here are the sales, which is 100%, of course, because every item is represented as a percentage of this. We can see that the cost of goods sold represents the highest percentage from revenue through all the years. 2016 it was 61%, and then it was increased a little in 2017, then it's declined a little, and then it declined even more in 2019. So the cost of goods sold through these is fluctuating. And if we go to total expenses in 2016 was 30%. The total expenses actually increased through the years. Like, if we see here it was 30%, 30.80%. Here it was slightly increased, then slightly increased, slightly decreased here in 2019. But what's more important thing here are the net profit or loss. We can see here that 2016 was the most profitable year. If you go through the report and see the actual income statement, you'll see here that it generated over 94 million Saudi riyals in 2016. And that represents 4.53% from the total sales. And then it decreased in 2017 by this amount. In 2018, it was 0.08%, which is significantly lower than this 4.33%. And we can see here in 2019, the minus here indicates a loss. So they had a loss worth of 0.33% from the total sale. Moving on. Now we're going to discuss the profitability ratios, and we're going to explain every one of them. Gross profit margin. Before explaining the formula, we're going to give a brief explanation for this gross profit margin. Gross profit margin indicates the percentage of gross profit from the total sales, and operating profit here indicates the percentage of operating profit, which is the profit after deducting the expenses and the operating expenses. How much it presents from total sales, and what percentage do we have left to cover the income, interest, and income taxes. Net profit margin represents the net profit percentage from total sale, and return on asset actually represents the net profit that's been added back to the assets in the balance sheet. Return on equity represents the how much earnings per share we're going to calculate for the year. And these are the formula. The gross profit margin is gross profit divided by revenue. Operating profit margin is operating profit divided by revenue. Net profit margin the formula is net profit divided by revenue. Return on assets, net profit divided by the total assets. Return on equity, net profit divided by shareholders' equity. And after calculating all the ratios, we can see the results here. These are the years, and this is the name of the ratio. And this is every ratio for every year. So gross profit margin. We can see here that in 2016 was the highest, 38.50%, and then it decreased a little in 2017 by 35.97%. Then it increased a little, then increased a little in 2019, but 2016 is still the highest gross profit margin. Operating profit margin, we can see here that actually almost the same. 2016 is the highest, then it declined a little, then it declined more, then it's rose a little bit in 2019. Net profit margin, now we can see here we have minus because the net profit margin, the formula for it is net profit divided by revenue. So in 2019 we can see here a minus because there was a loss, and also here in return on equity there is a loss, so there is a minus sign here. So we go through the net profit margin, which actually is represented before in the common size of income statement. At the end, it is the same. So no need to go through it again. We already explained it. But we can see here that there is a loss by 0.33%, as we said before. Now, return on equity, on assets, sorry. This is new, we never experienced. So, as you can see here, in 2016 was the highest. The performance in 2016 in general was at its peak. 2.53%. In 2017 was decreased, and 2018 it even decreased more, and 2019 we had a loss, so it's a minus sign here. Same goes for the return on equity. We can see here that 2016 was the highest, and in 2017 it decreased even more, then we have a loss. So even though 2016 was the highest, but most of the investors consider a return on equity than less than 10% is poor. So in general, all the years here didn't even perform perfectly for investors. And we can see here that's the profitability ratios graph, so you can see it even more clearly. Now you can see here in 2019 we had a loss, so it's a little down the line because it's in minus, and same goes for all the ratios. Moving on, we'll go through the liquidity ratio. Liquidity ratio, what is the liquidity ratio? First of all, liquidity ratio indicates the company's ability to pay short-term liabilities. So we have three ratios here. Current ratio, which is current assets divided by current liability, which means that how much the company can pay off current liability using the current asset. The quick ratio, which is indicates the company's ability to pay short-term liability using current assets minus the inventory. As you can see here, the formula sits the same: current assets minus inventory divided by current liability. Cash ratio indicates the company's ability to pay short-term liabilities using only cash. So it's straightforward: cash divided by current liabilities. If you calculate the ratios, we can see here the results for every year. The current ratio. Instead with the current ratio, we can see in 2019 is actually the peak, because it has the, as we said before, in the common size balance sheet, they have the less, the liabilities have decreased in 2019, so that's why here is the highest. Even though it's the highest, but it's still considered poor. They can't even pay all the current liabilities using their current assets. So, in my opinion, this at least should be equal to 1, at least, or else it would be considered poor. So through the years here, you can see none of the years can pay all of the current liabilities using the current assets. So that could indicate a risk actually. The quick ratio, which is minus the inventory, we can see here 2019 is also the highest because the lower percentage of liabilities, and it's still considered a little poor. Cash ratio, they can only pay in 2016, they can only pay 4% of the current liabilities using cash. Here 3%, 2%, and 5%, which is actually could indicate a real big risk here. And this is if we like to see the quick ratio, liquidity ratios in their trend. Here are the years, and this is the lines indicating how well the company is going through the years. Quick ratio here, current ratio, and cash ratio. Cash ratio, as you can see, there's not much difference, so it's almost like a straight line here. Moving on to solvency ratios. What are the solvency ratios? Solvency ratios indicates the company's ability to pay off their long-term debts or liabilities. So we have two here, long-term to equity, which is long-term debts divided by owner's equity. And we can see here the financial leverage, which are total assets divided by owner's equity. Now, financial leverage means that how much the company is financed, what's the percentage that, what's the highest, actually, let me explain, sorry. It indicates that the company's assets are financed by either shareholders' equity or liabilities. What's the most finance source here? So if we calculate it, we can see here this is the calculation for all the years. And we can see here long-term to equity. We can see in 2016 was the highest. And it declined a little, then more, then it rose a little bit. The financial leverage. Financial leverage actually, if it was the ratio, if the value of the ratio was 1, that means it's okay, it's good. Higher than that could indicate risk. And we can see here that it's significantly higher than 1, which means that most of the company's assets are financed by liabilities. Now, as we said before, the liabilities have been decreasing through the years until 2019. So we can see here it's the lesser ratio. Actually, it's equal to 2018, sorry. But they are still the least ratio we got. In 2017, he was the highest. They had the most liability here. And this is the graph showing the trend of how it worked actually. We can see here that this is the ratio. These are the years, and the red bar or the orange bar represents financial leverage, and the blue one represents long-term to equity ratio. Now we move through the DuPont analysis. So what is the DuPont analysis? DuPont analysis is actually based on the return on equity, and it's used to break down the return on equity into different components. So and we have we do it to have a more clearer picture about a certain amount. It measures profitability, efficiency, and solvency more effectively. So, why do we do this? Why do we break down the return on equity? Let's say there is a certain amount that you don't know how there is a problem in some account, and you don't know where it is. If you do the DuPont analysis and break down the return on equity into the 5 different components, you can see more clearly where the problem is, and you can indicate it, and you'll know where the problem needs fixing. So if you can see here, this is an example of the DuPont analysis, how it can be break down. This is the return on equity, which equals to net income divided by the shareholders' equity. If we break it down, this is here. This is the formula for return on asset. We can see here net income divided by total assets, and here total assets divided by shareholders' equity. Now, if you cancel these two together, you're left with net income divided by shareholders' equity, which is the same as here actually. So, if you break it even more down, this is net income divided by revenue, which is the net profit margin. And here is the return on assets, revenue divided by total assets. And no, sorry, this is the asset turnover. I'm sorry. And here is the total asset divided by shareholders' equity, which is the financial leverage. So if you multiply all these three together, you'll cancel this one with this one, and you'll cancel the total asset with total asset here, and you're eventually left with the net income and over the shareholders' equity, which if you go back here, it's the same as return on equity. This is even a more extended look on the formula, but we're not going to use that because Nadec'S income statement does not have EBIT, so we can't break it down to this level. We will be working with this level only. So if you go down, this is our two-point analysis. The net profit margin equals minus 0.33%. Asset turnover equals 0.56%. Not percent, sorry. This is ratios, not a percentage. The financial leverage equals to 2.74. So the return on assets, which equals to the net profit margin multiplied by the asset turnover, as we can see here, equals to minus 90%. If you go, this is, by the way, this is the information provided by 2019's financial statements. So as we can see here, it's minus 90%, and if you go back, you see that this amount is the same for the return on asset. The return on equity equals to return on asset multiplied by the financial leverage. So minus 19% multiplied by 2.74 equals to minus 52%. And that's the actual amount for 2019 of the return on assets as we calculated before. So as conclusion, we can see that assets are mostly financed by debt. 2016 was the most profitable year for Nadec, and profit is declining through the years. And eventually in 2019, sorry, we had a loss of 0.33% from total sales. So my recommendation here, I can see that clearly the company is at high risk. I wouldn't recommend anyone to invest in it anytime soon. We can see that profits are declining, and we had a loss in 2019. So it's not really a good time to invest in Nadec anytime soon. So this has been my analysis, and I hope that I helped you to make an invested decision. And thank you for watching.